And look, you can be a giant pain in the ass, but if we can be good on working terms, I'm cool with that. I've dealt with people that were a giant pain in the ass my whole life. And furthermore, the people that know they're a giant pain in the ass are usually the ones that respect you the most when all is said and done, because they're like, I know I'm difficult and I appreciate you like walking through this with me and dealing with my difficultness. And I'm like, absolutely. What's up, y'all? Welcome back to the Austin Home Guy podcast, the podcast that talks all important and relevant real estate. It's the guide for we are the authority on real estate, all real estate across Austin and the United States. And when I say that, I'm completely full of crap. So
Texas, let's narrow down to Texas.
There are people out there that are way smarter than me talking about, I like to tell stories about real estate transactions. I know my stuff, but I'm not as there are people that love to get into the weeds about contracts and everything else. And that's not necessarily my favorite thing to talk about. So, but today I'm talking with Jonathan Sarver, broker and owner of Hill Country Mortgages. Welcome, Jonathan.
Thanks for having me.
So let's start here. Why don't you give us a quick rundown of like where things are at the moment with interest rates in the market, and then we'll jump into our conversation from there.
Yeah, so I mean, rates are still around the 3-year low mark. So everyone was posting about it. A week and a half ago. 5.99. We did go up since then. There was the whole, the $200 billion bond market bond buy that was announced. That hasn't taken place. Partially has. They're going to make that over time. But then immediately, the DOJ investigating the Fed market didn't like that. They don't like when those powers combine. And then the whole Greenland stuff was kind of an issue, but thankfully that got worked out. We bounced back a little. I mean, we're still, I would say, market average probably between 6 to 6.2. Right now. It's all going to be depending on each individual, credit, down payment, loan size, all that stuff.
Yeah, and that's about average where we've been looking at for the last, year or so?
Probably the last 6 months. I mean, the tail end of 2025. Yeah, tail end of 2025, we definitely saw a more steadily improvement going into 26. I mean, I think we opened 2026 over 1% better than what we opened 2025 at.
Oh, that's great. Yeah.
So that was nice.
What is, and so how much of like the bond market stuff with the buybacks, like does the retail market, how much out in front of the rest of the market will the retail market be as far as like potentially bringing rates down? And do you see rates trying to coming down a little bit in the spring, or do you think things are going to kind of stay strong or hold steady where we're at?
The optimist in me says we're going to continue a gradual trend lower. Pessimist in me says we're going to stay in the same range. It's all data dependent right now. It was jobs and inflation. We had manufacturing and PMI today came in a little over, I believe. Wasn't a big deal. I mean, we're pretty flat on the day. So we haven't had any reprices during the day. And it's funny. I always tell clients, they're like, "Oh, what's your rate?" I'm like, unless you're making an offer and we're locking in, it's going to be different by the time I hang up.
Yeah.
Especially the last 3 years, we've seen rates change multiple times a day even. So, I mean, the bond program, there hasn't been a full set plan of like how the buying is due. There was already buying happening with the bond program from the GSEs, which is Fannie and Freddie, and the Fed, that started happening last May. Just wasn't announced. And it's not near the same amount of what we were looking back during the QE and all that stuff during COVID. So, $200 billion is a lot. But they were doing that, I want to say, weekly or monthly back in COVID. So it's definitely going to help, but we need the data to go along with it as well.
Yeah, that makes sense. So so obviously you have a bunch of different loan products. Not everybody fits into one loan program. And more often than not, unless you're a simple W-2 employee with a large down payment, those are the, slam dunks. So
the triple A's,
the one's easier for me to we can write in a quick close, usually because we're pretty confident, W-2 employment. Once everything's been run through, underwriting's usually, cake, unless they have income coming in from offshore accounts or something. But for the most part, relatively simple loans, right? So there's some more complicated loans. Why don't we talk a little bit about is the 30-year or 15-year fixed the best program on the market right now? Is it smart for people to jump into an arm at the moment? And then maybe what are some creative things? And we'll after that we'll jump into like, hey, what is a how often do we run into bank statement loans? How often do we
Yeah.
run into
I got a
banks?
perfect bank statement story I'll tell you in a second. In 14 years, I can count on both hands combined how many arms or 15 years I've done. I've always been a big fan of the 30-year. And of course, people are like, oh, you pay more interest over time. There's no prepayment penalty. So you can pay a 30-year as aggressive as you want, but it gives you the flexibility to say, like, oh, we're going to save up for Disney World, or I want to do something else this month. Then you just have your 30-year payment. So that's why I've always been a fan, because it gives you the flexibility of it, because you can always do extra principal payments. I have not seen arms in years have a rate low enough to really make sense. When it comes to like conventional financing, private banks are going to be better options for arms, but on the wholesale side and the retail side, I just don't think arms are really ever worth it unless it's a substantially lower rate. I think people always worry about like, oh, well, arms, if it goes up, they're not going to qualify. Well, you qualify on the max adjusted rate anyway. So if it's at 5, you're qualifying on 9 or 10 anyway. So it's going to suck if that happens. So there's no really concern about that. Everyone always talks like, oh, it's 2008 all over again. I was like, it's nothing like that whatsoever.
It's
Um,
interesting
so
because I have 3 different sets of clients that I've talked to in the last few months that purchased with an ARM, over, in 2022 or 2023, that are now this year is the year they're maxing out, right? And they're all trying to refinance into, and potentially it's interesting because a lot of what, those conversations have been, they may end up refinancing back into other ARMs because
yeah, I mean, it can make sense. I mean, especially, yeah, if yours is adjusting from 22 to 23, it's going up quite a bit.
yeah, and that's been the sediment. So I was curious what your, you know, I know that I agree with you. The 30-year fixed tends to be the best product because it has the most flexibility. Cheapest, typically the cheapest overall payment. So if you don't want to make extra payments, you're good. But if you do want to be aggressive in paying it off, making extra principal payments, you're not going to get, slammed for that. And then usually they have they usually give you options, like if you ever wanted to put like another large chunk at
Yeah,
principal,
like
like
that's the
a
recasting.
readjustment, yeah, a
Yeah.
recast, 1 or 2 during the life of the loan. So
Yeah, I always felt I've had clients be like, "Oh, I just put, $20,000 towards the principal." I'm like, "Well, did you recast?" They're like, "Well, no." I'm like, "Well, if you recast, it's gonna re-amortize based on new loan amount. So it lowers your payment with it when you do the recast."
yeah, and the recast doesn't, I mean, it's not like a refi, right? The
No, no,
recast
no. It's like a 200.
re-amortizes your,
Yeah.
on the schedule that you're currently at.
Correct. Yeah, and then you just reach out to the servicer. They usually charge 2 to $300, and then about 2 statements later, it'll go into effect. But yeah, no, it's not a refinance or anything like that.
Yeah. That's interesting. So tell me about your bank statement loan. I'm curious because I've done a few of these over the years. A few that we had to get super creative on some. So I'm
Yeah.
curious what
So
your experience is like.
this is an interesting one. It was long story. This guy was actually someone I've known for a while. I'm not going to go into any more details actually after that. But he reached out to me. He's like, "Hey, do you guys want to help me with the mortgage?" I was like, "Yeah, of course. That's what I do." And he's like, "Oh, we found a house." And I was like, "What? Get your application in." And I started looking at everything, and I was like, "This isn't going to work, dude." He's self-employed, and people are saying, "Oh, self-employed is harder to get a mortgage." I'm like, it's not harder. It's the math just changes. If you're going to write off everything on your income, so you're not paying taxes, you don't get to count the income then. So that's where bank statements come in a lot. And thankfully, what we've seen the last 3 years is, bank statement rates have been around forever. They used to have a lot higher rates. Now they're just a little bit higher than what we currently have. So they're great options. So essentially, I was like, look, he opened his own business a year and a half ago. I was like, give me your last 12 months bank statements. And then, we compile it up. They look at all deposits, they take out stuff that shouldn't be there. And that's how we give you your income. And there's always a what's it called? Expense factor they use on it too. So it's not, you don't get 100% of your deposits. And depending on your line of work, if you're an inventory heavy base, they'll give you 50%. If you're, clerical and it's just like sales or something like that, like if you or I did it, for instance, they'd probably do a 15%. So you get 85% of the deposits as income. So, but yeah, I mean, this based on the tax returns, it tripled the income we could use. And yeah, so it knocked it out. But it also goes to my point where I tell people all the time, and people think, "Oh, so you're just trying to trap me into your business." I'm like, "You just don't look at houses unless you've been pre-approved." He said, he's like, "Oh, the builder's lender told me I was fine. I'm not going to dog on builder's lenders, but it's different. And I was like, dude,
They're
it
gonna
took me
tell
30.
just about anybody they're fine, at
Yeah.
least at the start.
Well, it took me 30 seconds to look at his documents. It's like, dude, it's not going to work. I was like, bank statement will work. I mean, let's get those in, but you don't have 2 years. You don't always need 2 years when you go self-employed, but in certain more often than not, you do. So you don't have the 2 years there, and especially if you just had a half year, and then if you filed 2025, you have a year and a half, and then we're going to average. It starts really low. Bank statement's just going to be the better way to go from, and we got that locked in right now and close in like 2 weeks, I think.
Dude, that's amazing. Yeah, I run into this personally because I have to be careful. Like when my wife and I are thinking about any kind of major purchase, we have to make decisions about how much we write off on our taxes, like, and everything we write off is actually a business expense. But when we get into it, there's certain business expenses that we may not want to write off to make sure our income stays high enough, so we can get approved if we want to, purchase in the future. It's kind of a,
Yeah,
it's
it's a
kind of a pain
double-edged
in the
sword.
butt. Yeah.
Yeah, it's like you're not going to get the benefit of both sides.
Yeah, you can't. And so there are years that we have to like take into account, like, oh, if we're thinking about buying in the next year or two, or, making a change, that we have to, pay a little more in taxes to make sure that we're counting the income to approve for the kind of house we want to purchase.
Yeah. Well, and there's different write-offs, like on a Schedule C, for instance, that are you can add back. The biggest one that people, especially in our industry, use a lot that is a double hit is, travel and meals reimbursement. So that's a write-off on the tax return, and when we do our calculation, we deduct that again. And it's like, that's what
Oh,
yeah, so it hits you twice. So, like, business use of home is a great one. I always recommend people use depreciation, depletion, and then if you use your vehicle, you keep track of your mileage and all that. That's all stuff that can be added back into the income. So we never just look at the gross on anything. But the meals, the travel and meals reimbursement, that one hits people twice because sometimes I'll see people like, $8,000 every meal I had this year. I'm like, great, we just deducted 16,000. So that's one thing let's keep an eye on. Like it's but yeah, but I made a post this on Facebook the other day. I was like, it's not harder to get a mortgage if you're self-employed. The math might just be different. We might have to look at different ways of structuring it. You might have to, bite the bullet and pay more taxes one year, or the bank statement option's good. And there's also, I mean, there's P&L loan options. There's a variety of options out there. It's a matter of finding which one fits for you and which one's going to get you the best pricing.
yep. So you do a lot of loans. With that being the case, what is the most common, like, what's the most common thing that people lie about on loan applications that you end up finding out after the fact, or the thing that gets people dinged, like that you're playing catch up on, later?
Yeah, thanks. I've been doing this long enough, and I've have a really good system where I can't remember the last time something surprised me because we do a lot of the groundwork up front. Like my pre-approval letters have the specific house that you're offering on. Like I don't give a generic one, and I don't give them out until I have your full file because when I first started, I made plenty of mistakes where I just took a bit of self-employed
Did,
person's word for his
didn't we
money.
all?
Yeah. Well, I remember this was like in 2013. This one guy self-employed said he made all this money and I pre-approved him. And once I got the tax returns, I didn't know how to read them yet. I was like a year into it. And once I read his income was like a third. And I was like, okay, so that's what I was like, you don't get pre-approvals done everything. So, I mean, the biggest thing is people, they overestimate, bonus income or overtime income, stuff like that. But that's where we clean it up front on the end. It's if you get bonuses every year, if they're increasing, we average. If they're decreasing, we use the lowest one. But if they decrease too much, we might not be able to use that at all. So there's different ways to look at it. Like, I mean, if it drops like 50%, you're going to have to explain it really, really well for us to be able to try to use it. I have 2 deals right now that um, they use RSUs or restricted stock, big in tech companies. People get that a lot as part of their compensation. That's a whole other way. You can use it as qualifying income, but there's different ways to do it where I don't even trust myself to do it. So I have 2 right now that are with one of my underwriters doing TBD. So I was like, I want to make sure I have it exact before they go under contract and put an offer on something.
Interesting. Yeah, that'll be interesting. I might have to pick your brain about that at another point. Yeah, that's the catch-22 with real estate, right? It's like the barrier to entry into our industry isn't that steep. I got my real estate license relatively easily, but like 11 years into this, you very much realize like expertise and experience are a critical aspect because so many of the mistakes I made in those first years of being in real estate are the reason, I can advocate and protect my clients now, which you do the same thing. And people just don't understand that. Like your first year in the industry, it's a rough 2 years.
Yeah, when you wanna say yes to everyone and everything.
Yeah.
So you feel
Yeah. You,
like
you want
here's
to,
the yeah, especially on your end too. You're like, "Oh, you wanna look at a house? Let's go right now. I'm gonna drop everything and run."
yep.
And they have a 400 credit score and not even employed.
Correct. Yeah. I'm
Yeah.
like, I don't even know if I could get you into a lease.
Yeah.
We've been looking at $700,000 properties, and I'm like, I don't even know if, based on your income, if I can get you into like a $2,500 a month lease. So like, yeah, you start to learn and you start to trust too. Like, I've noticed that when people are hesitant to buy into the process I've created, because the process that I've created for my real estate business is to benefit other people. Look, when you buy into my system is like, it's guaranteed. Like once you've gone through these steps, we know exactly what you can purchase, and the process is fun, right? You do the legwork up front, like getting pre-approved. So we have a great understanding of everything that's working against us. Because, and I will say this, one of the hardest parts about the last few years for me in my industry is, you know people look at loan calculators, they look at general information, and they're like, I can afford this, right?
Yeah,
And you're
it's
like,
that I always tell people, avoid online calculators, online stuff so much because, I made a video about this too earlier last year about, like PMI, for instance.
mhm,
PMI on any of those mortgage calculators is insanely wrong. Like I think in the video, this one of the calculators was $250 a month, and I showed my actual calculation was 65 a month. So like it can be way too high. The other thing I always tell clients is, uh, I'm going to estimate taxes and insurance on whatever purchase price on it when we, pre-approving you. But when you start looking at houses, send me the addresses because I'm going to look up the taxes because you can find three houses at $500,000 and it can be thousands of dollars of difference in taxes.
yeah, and that's actually the point I was about to make because
Yeah.
so often, like, so for example, if we find like a $450,000 house in South Austin at a 2% or a 1.9 tax rate, I have clients look at houses in Sunfield and Buda, which there's parts of Sunfield that are still at 2.8 or 2.9. That's a potential $4,000 to $5,000 difference in property taxes a year, which that's a significant increase in your loan amount.
Well, and then the other thing is they don't know what the tax assessed value is.
Yes.
I mean, you can find a $450,000 house that's taxed at 300 or taxed at 520. Some people
Yes.
don't challenge their taxes. So I was like, that's why I'm like, I'm gonna always my rule of thumb is when I pre-approve, I use 85% of purchase price times 2.5. And that hasn't steered me wrong. And that's kind of where but then I go, okay, once you start looking at houses, send it to me.
I was gonna
'Cause
say, because even like out towards Lakeway, Sweetwater, Rough Hollow, then you get into Dripping Springs, Belterra, you get out down to Kyle and Buda, like anything that they used a mud to build out those communities, tax rates typically a little bit higher. And if property values in Sweetwater and Belterra and Rough Hollow went through the roof during the
oh yeah.
2021. Like you were paying, if you were paying 2.6 to 2.8% on a $500,000 valuation in 21, and then in 2022 and 2023 now your valuation is 900,000, which was a realistic scenario for a lot of those
Oh,
homes.
I have a personal story on that too.
Yeah, your tax bill just went up 10 grand a year you
Oh,
know
yeah, and that's why I always remind people, follow your homestead. I've been doing more refinances lately, and I found people that haven't done their homestead. I'm like, "You're just giving away money." But it's funny, so I live in Rough Hollow, and we bought our house, and we closed in the beginning of '21, right before things went crazy, and in 2022, because back then you had to wait till January 1st to file your homestead, my property tax bill tripled,
oh dude.
and I was just like, "Well, I'm moving." I was like, "I'm glad I got a lot of equity now, but I would never have paid that much for this house a year
Yep.
ago." Uh, but thankfully, I use a Dennis and Gill to do. There's a plug for them to process my property taxes, and they've cut it down by like 60% last 3 years.
Yeah.
They've got it done every year.
We use Texas Pro Tax, I think
Gotcha.
now, and they've kept ours. Ours jumped a hair, but ours has come down significantly over the last year or two as well. We're in South Austin, so it's our tax rate's a little bit more beneficial because our house was built, but the difference is our house was built in the
Yeah.
'80s. So uh,
Yeah, I had a house when our first house was down in Shady Hollow, and the tax rate was
yeah,
like 1.6, and out here it's 2.8 to 2.9.
yeah. Dude, that's been the hardest part about the new construction over the last few years. And also a critical part that people's understanding, like even when you're working with a new construction lender, like we learned the hard way probably 5 or 6 years ago. I had a couple clients buy in MUDs and they didn't realize how much the property taxes were going to be when they came in. And, you have to make sure that stuff is super clear with people.
Yeah, I mean, it's especially new builds, especially a lot of times. I personally advise people not to escrow on new builds if they're comfortable with saving money. Like if somebody has
Interesting.
if they're they're financially sound, they're good at saving money. I usually in general say don't escrow, because escrow account is just a bank account you don't have access to. So I mean, if you could put that money aside monthly on your own, earn some interest on it, do it that way. But I advocate for that for people that are comfortable with it. I don't push it by any means. I explain it because on new builds, because you just don't know what's going to happen. And I've dealt with people that bought new builds and I didn't do the purchase, and that lender got lazy for them and just used the dirt value with the taxes and pre-approved them that way. And their taxes came and their monthly payment went up $1,200 a month or something. And
Yep.
I'm like, it's like it was such an easy, and not to just dog on a lender. Frankly, I think that's also like a realtor's job as well. Like they should be knowing, like they didn't get good advice from anyone in that transaction.
Yeah, well, and
But
there's a lot of realtors that aren't involved in new construction as well, which is why I advocate for people to get us involved, because this is the kind of information that conveniently gets left out, and
oh,
then
the
people
builders look it out for themselves. Like that's one
always
thing. They have no. They're there to sell the house, and it doesn't cost a buyer anything to have their own agent. I've had people tell me like, "Oh, I'm not going to use it to negotiate more." I'm like, they're not going to give you a discount because of that. That's built
no,
into their spreads. Like they don't
it's
care. They're just going to make more off you. They're not going to give you less.
yeah, this is a true statement. Builders pay agents out of their marketing budgets, not after the price of the home. It's different than a resale system, and so those marketing budgets are already caked into their overall budget scheme. So by not using a real estate agent, they might tell you like, oh, we'll give you like an appliance package or some other thing.
Yeah.
And I'm like, yeah, if they tell you that they were going to give you that for not using an agent, there's a 99% chance I could have negotiated that as well and still
Well,
gotten
and
you
also just
representation.
simple math. Like say it's a
Yes.
$500,000 home. I'm like, okay, so they save 15,000. So they're going to give you $1,200.
Yeah.
What are we gonna do? I don't know. It's like, but no,
Yeah.
it's but I just I wouldn't I never understood someone that like I've been in I could do it myself down an agent, so I've been it around it enough. I would never want to do that. I have a rental property in Manor, and I reach out to my buddy as an agent. I'm like, I need the lease renewed. Like, I don't want to deal with this at all. Like, I don't have a property manager. It's just one house, but yeah, and it's just it's I don't understand the pushback against it. There's always been like, oh, the whole NAR thing or whatever. I'm like, it was always negotiable. You never had like I don't know. There's so much misconception around all of it, and it was so frustrating for me because like I cherish my realtor partners and relationships, and like I want everyone to make their money, but like people made it out like they were scamming people, and were there bad apples? Of course, but at the end of the day, it's like it was always a negotiation.
Always.
Like,
And
yeah,
it's really about, and I will lay some of that at the feet of real estate agents for, not being like, there is a process, and I've learned over the years, like whenever there's something that's feels a little uncomfortable to talk about for me, I'm going straight at that thing. So like
gotcha.
when I meet with buyers, when I meet with sellers, we're talking money right out of the gate for transparency's sake. Like because my goal is like, look, one, we have to be on the same page here. So everything else is a moot point if we don't get to a situation where you understand A, that I'm getting paid and how much, and then B, like I want you to be in support of that based on the work I'm going to do. And if you're not, then there's no point in moving forward beyond that
Yeah,
anyway.
don't waste each other's time.
Let's not waste each other's time in general. So,
Yeah,
all
when
right.
I tell my agents also, I'm like, you know, if they ever tell me like, "Oh, I didn't get a buyer's rep signed yet," I'm like, "What, dude? If I had a protection like that as a lender, I would be offering $100 gift cards for people to sign that." I'm joking, but like, I would if I had something like that, that would be signed every single time.
They don't protect you that much anyway.
No,
Like
we don't.
really,
We have no protection on the lending side.
yeah, you
I've
guys.
done hours of work for people. One quick story for your next point. I had to do this was 10 years ago. We literally got clear to close, and the guy was like, "Oh, well, the other lender's clear to close too. I'm just going to close with them." He had dual transaction the whole 30 days,
Oh my
and
gosh,
the agent didn't know. I didn't know, and I was just like, "Wait,
dude.
you paid for 2 appraisals," which the listing agent didn't tell. I don't. I guess they just didn't notice it. But yeah, that's the only time it ever happened to me. But I always tell people like, look, if you're going to shop around, I encourage you to. I'm going to beat most people anyway.
The
But do
cost
it
of the
before the con.
appraisal probably eats into whatever they were saving.
Yeah. Oh,
It's
for
like,
sure. Yeah. I was blown away. I was like, dude, I do this every day, but I wouldn't do it for multiple people if I didn't have to. Like, why would you do this 2 times with 2 different people?
yeah, dude. You learn early on in this business that there are people that are your clients, and look, I am okay with dealing with difficult people. Like
Yeah.
as long as that sense of loyalty is there, loyalty and communication. Look, you can be a giant pain in the ass, but if we can be good on working terms, I'm cool with that. I've dealt with people that were a giant pain in the ass my whole life. And furthermore, the people that know they're a giant pain in the ass are usually the ones that respect you the most when all is said and done, because they're like,
Oh,
yeah,
yeah.
I know I'm difficult and I appreciate you like walking through this with me and dealing with my difficultness. And I'm like, absolutely. Because we were honest about it up front. It's when it's the opposite, when you can't address the things on the front end, and then people are going behind other people's back, they're lying, they're
Yeah.
doing, that's when it
Well,
gets.
and usually, and the people that are more, blunt, I'll put it in a politically correct term, are usually end up being your best clients. And like, my thing
Always.
is, I'm available pretty much 24/7. I work from home, and I own my own company, so it's. I always tell people text me anytime you have questions, like 7 days a week. And the clients that text me and we can start joking around a much, like I this really is relationship building for me. Like I have clients that I closed 5 years ago, and like we'll hit each other, like I've hit them up for a refi, just talking
Yeah.
like we're best friends. Like it's
Yeah.
just it's the clients that like, and there's certain clients that you have that where you're like, once the deal closes, you're like, I'm not even gonna put them on my CRM.
Definitely have some of those.
Yeah.
Yeah, every once in a while you close one and you're like, I'm
Yeah.
okay if we never
Yeah.
speak again.
Yeah. Once that check clears, block.
You're like, I hope they don't contact me to sell in a
Yeah.
few years.
Yeah.
Uh, no, but well, okay. So let's end on this. If you were giving one, so say somebody's thinking about buying in the next year or so, they're haven't done much prep work. What recommendations would you make for somebody that's thinking that's like on the fence at the moment, but's considering jumping into the pond?
I mean, get with a lender ASAP, whether it's me or someone else. I mean, most of us now do soft credit pools up front to start. And so at
That's a big
least
deal to let people know too. I
yeah,
would
well,
say
because you got a
almost
financial
everybody,
foothold.
yeah, almost every buyer I talk to, their biggest thing about wanting me, and when I send lender contacts out to people, almost always their first question back is always, are they going to do a hard credit pull? Like,
Yeah, and
is
let's be
this going to
clear,
impact my
it,
credit?
and that's such an overblown worry too by people.
I know.
Let your getting credit pulled a lot. It's not going to do anything really, and it's good for 90 days. So that's why I ask people like, when are you looking to buy? If you're looking to buy in the next 30 days, sure, we could do a soft too, but based on our conversation, I don't foresee any issues. Let's just knock it out right now. Go for it. But yeah, I mean, with soft credit pull, at least is if someone's planning to buy this year, not a set time frame, get with the lender. You know, go over your numbers. Because there's so much bad information out there. People are like, oh, I have student loans. Doesn't matter. If they're in deferment, depending on which program, with Fannie Mae, Freddie Mac, or FHA, on average, we're going to use 0.5% to count as a payment. Like we're going to count a payment even as a deferment. And people say, "Oh, well, I have a lot of debt." I'm like, "I don't care. It's all about the payment." How much your payment? So and people have just this, overall like being hesitant about it. I'm like, soft credit pull, it lets you know where you're at. Also, if there's an issue, we know what we can do to address it, whether it's quick credit repair or it's like, hey, save more here or pay this card down here. Or hey, your auto pay has not been working. You have a bunch of 30-day lates. I don't auto pay anything for that reason because I've just seen it. I've seen thousands of credit reports and I've seen the smallest missed payments or smallest collections just torpedo stuff. But yeah, there should be zero reason not to just start the conversation with somebody. Now, if you're like 2, 3 years out, you're wasting everyone's time. And if you're like 6 months to a year, like that's a timing freeze. That's a strike point. Here's what you do: get your credit up. Here's how much you need to save. You know, factor in down payment plus say 3% to be on the high side for closing costs, and just figure out where you're at. And then people are like, oh, what are rates? And all right, are you putting an offer today? Well, it doesn't matter. And also, without knowing your credit, loan amount, down payment, type of property, your income is a big one now because different income levels affect pricing. I was like, also, my favorite thing too is like, what rate do you want? Because you can get any rate, it just changes the cost. When you see rates advertised, that's just the par rate, meaning you're not paying points. But if someone wants 5% today, they can do it. It's just going to cost more than a down payment. So,
Correct. Yeah. Yeah. You're just gonna the bank will always make money. So
yeah,
there's one truth in real estate, and that's that
yeah,
the banks win. So
yeah. The big house comes out on top.
always,
Yeah,
always. But if we get what we want in the process, that's we have a house, a place to call home, a good life. That's the end goal with all this anyway, right? So, well, dude, thanks for coming on and sharing your perspective, man. I'm
pleasure.
sure we'll be doing this a few more times over the course of the year, I'm sure. So yeah, Jonathan Sarver, Hill Country Mortgages. Thanks, man.
Appreciate it, man. Thank you.